Morning all. How are we all doing? Morning Danny, morning Neo, Fire, Virginia. Sorry I'm late. My hair's still a bit damp. Just got out the shower. I was doing some coding for the members stream and I completely lost track of time. And I was like, oh, I've got to be on in 5 minutes. So yeah, morning. Indices this morning. I haven't even got my pen open. Totally unorganized this morning. So short break on the FTSE this morning on the pre-market range. Just about to break along on the DAX by the looks of things. Although it seems to have stalled. So fairly tight range this morning in the pre-market. 5-minute candle on the FTSE. Absolutely killing it this week on opening range breakout and stock index hedge, whichever one you're using, if you're using it. It's been an absolutely monster week. Literally clean breaks everywhere, or hedges which have all gone perfectly to support resistance and bounced. It's been like literally 4 out of 4 every day this week. It's amazing. So obviously today it'll all go wrong. But anyway, DAX broken along. So upside target on the DAX, obviously we'd be looking at yesterday's higher ADR. FTSE's short break. Bit tricky today on the FTSE because we've got yesterday's low looming and the previous day low all within 3R. And then we've got the weekly low as well. So there's a lot of support to get through on the FTSE today. Very supportive area, this whole area. For the last 3 days, they've been buying this area. So we're breaking short straight into that buy zone today on the FTSE. But we'll see where we go. We'll come back to that in a minute. So today is Friday. Morning. Was check. Ryan, morning. No George. George even. No George. That's somebody else. Today is Friday. We've just got retail for the CAD today. There's nothing else coming out today. We've got the monetary policy report hearings. I'm going to cover the pound in a little bit more detail today because we've got the budget coming up. So need to be aware. Next week is a pretty crazy week, basically. Is it the budget actually next week? Are they? No, that's the autumn statement. Is it the budget next week or is it the week after? Don't know. I think it's next week. I don't know though. I'll have to check. But I'm going to cover the pound in a little bit more detail this week because obviously we've got the budget coming up at some point. And there's potential big shifts in how we do things in the UK. So this morning, the only news we've had is CPI for the Japanese yen, which came out slightly higher than forecast, but it's still dropped on previous. Retail, obviously, today as well. We have got durable goods this afternoon and the monetary policy report hearing. We've got Bailey speaking as well tomorrow, and Michigan this afternoon as well. Michigan is a very hit and miss. Sometimes Michigan sends it flying, sometimes it doesn't. 30th of October, is it? Yeah, okay. So that is next week, which is Halloween. Oh no, Halloween's the 31st, isn't it? Yeah, so there is. Why don't they just call it the budget? Autumn forecast statement. There we go. So that'll be, usually it's about 12:30 or something next week. So we'll look at that. Overnight news, the Bank of Japan, again, this morning mentioning FX movements. So we will be increasingly vigilant to FX moves, including those driven by speculation. What they mean by those driven by speculation is the carry trade. So obviously it's almost like if you're Japanese, the entire world is against you. All they do is they sell your currency because they know they can make money with swaps by selling your currency, the carry trade. Yeah, so the entire world basically buys everything against the Japanese yen, so they make money overnight. So they don't like that because obviously it devalues their currency. So we're above the 150 level on the US dollar yen again, and we're holding as well. So we broke the 150 and we are sitting up nicely above. We had a down day yesterday, but we had the double ADR day this week on the ends. So yeah, Japanese basically not happy. So this will continue as long as we're above that 150 level. They will continue to mention this on a daily basis, just to let the market know that they have the power to completely destroy anybody that has a long position. Yeah. So they will just basically liquidate all their overseas assets, buy the yen. The yen will be powerful as whatever, and you know, it will just collapse. Everything will collapse against it. So this is their way of just saying, guys, don't forget, if you carry on poking us, we will just shoot you. Yeah, and they do it regularly. So this is the level they do it at. So just be aware, if you've got any longs and you are running any carry trades, you're being warned. So other than that, overnight news, there's nothing. So we had the CPI there, as I said already. But apart from that, not a lot else. No more escalation in the Middle East. All seems to be, it's still going on. There's still obviously rockets firing left, right, centre. There's still troops on the ground everywhere, but there's no escalation. The Russian movements with North Korea are basically, it looks like what they're doing is they're just training them at the moment, but they're going to use them to bolster the Russian defenses within Russia. So if they are not sending them into Ukraine, that means that everyone else just sits there and goes, yeah, whatever. If they do go into Ukraine, North Korea, it means North Korea have also joined the fight, which will potentially again escalate things. So again, Swiss franc yen positions, Swiss franc and the yen will massively power up if that was to happen. So just bear in mind, there's a lot going on in the world at the moment. Next week, we've got the elections for the US on the 4th. Well, it's not next week, is it? But it's the 4th of November, isn't it? I think the US elections. 5th, all day. So yeah, 5th. So that's basically on Tuesday next week. So with the US elections and with budgets, the reason I wanted to cover this all this morning is because we've got two potential huge market moving events coming in next week. Yeah. So the budget in the UK. We'll have a look at everything else. There's no ADRs or anything to look at this morning so far, so there's no ADRs to look at. The weekly one we looked at yesterday, and the RSI dashboard is flat apart from Euro New Zealand, so there's not really a lot else to look at in FX today. So that's the only extension you've got on the 4-hour RSI Euro New Zealand for shorts, and it's up at a weekly high, so good potential short opportunity there within that little range. But the pound US dollar, I just wanted to cover this. So last time we had a chancellor decide to completely upend the way that we do things, basically, the way that we use tax, borrowing, etc., etc., etc. The markets got massively spooked and jumped ship to the tune of over 10 ADR in 2 days. Yeah, so within 48 hours we dropped 10 ADR. Yeah, 10 times the average daily range. Anybody with any long positions on any pound were screaming. Bailey, as soon as that happened, obviously the government went, what is going on? Why are you upset about this? And obviously the banks explained it, and then the Bank of England bailed them out. So that is potentially happening next week again. So the current chancellor has decided to shift the way that it all works to try and free up roughly 50, 60 billions worth of extra borrowing. Yeah, extra borrowing creates interest rate rises. Yeah, our mortgages go up, everything goes wrong for us. If you're a saver and you've got money, you'd be going like that. But the vast majority of the population in the UK aren't savers with loads of money. They're hardworking people that are struggling at the moment and paying mortgages. So the market basically will be saying, when the budget comes out, if they do what they say they're going to do, doesn't look like you're going to be able to pay us back. They will jump ship on the pound. Yeah. When that happens, it tends to cause pressure from the Bank of England, and interest rates have to rally. Yeah, which makes the pound bullish. But before the bull move comes the collapse, and it will be pretty much what you see on the chart here from September 2022. Yeah, so just bear that in mind. I'm flat on the pound at the moment, and I'm not intending, I've turned the EAs off. I'm not intending to take any exposure on the pound this week or next week, just in case, because if you do get a situation where the market overreacts, and it will do if it doesn't like what it sees, it typically will become a V-shaped recovery because we have to unwind that move, and the Bank of England will force it. However, it's not fun being in 10 ADR of drawdown. So I'd rather be flat and nothing happen than be the wrong way and something go catastrophically wrong. Equally, you can't just go, let's assume that it is going to go wrong, because if it doesn't go wrong and the banks really love what she says in the budget, it's going to fly. So it's better to be flat. If you're going to use a stop loss based strategy, it doesn't really make any difference. But for position trading, probably best to steer clear if you can. Same with the US next week. It's the run up to the US elections. The US elections are incredibly volatile areas for the US because the same sort of thing. When a new president comes in, they typically have a completely different stance on economics. When you're shifting from one party to the other, and one party is like Trump, make America great, let's all pretend it's a business and treat it as such, and the others, which is let's look after the people, you're going to have a completely different economic stance, which completely changes the bias of the US dollar. So it's a 50-50 shot at the moment, it looks like, in the US, with Trump slightly ahead, which would be bullish US. And obviously, as we know, the US has been rallying into it so far. So over the next week, there's an awful lot that can potentially go wrong. So if we go back to November 2020 and November 2016 and have a look at what happened there. November 2020 is a bit of a difficult one, actually, because obviously that was COVID times as well. But November 2020, where are we there? Yeah. So it wasn't actually that bad there, was it? See, that's COVID. That's basically what happened to the US dollar. So we had a run up there. Oh, where's it gone? There. Yeah. So you got 2 days, which was 238 pips in total of movement, which is 4 ADR roughly. And then it continued. But the thing that you will find is you'll get a day, which is like 300 ADR. Yeah. So it's more a case of be prepared for massive volatility spikes around it. If we go back to the 2016, let's just have a quick look at what happens in the 2016 one, just to see if there's more impact on that one. There. Yeah. Actually, that's January. Let's go back. November. Where are we? So it's here. Yeah. So you got that massive volatility spike there again. So it's a 3-day sort of rally type thing is what you'd probably be looking at. So just be aware if you've got US dollar positions on, if it goes your way, hold it, because you're going to get out very nicely with a profit. If it goes against you and you've got exposure on, hold it, because the likelihood is it will undo itself, but it's not going to be pleasant. So, and if you're already in drawdown on something, obviously you're going to be adding additional drawdowns. So what I'm going to be doing with my US positions is just looking at them, and depending on where they are next week, it'll probably be a case of scaling out before the event. You always have to, when you're trading, assume the worst. If the best happens, brilliant. If the worst happens, that's what you need to assume, because there's a 50-50 shot of the worst happening, and you need to calculate what impact something may well have on positions that you've got on. So just be aware of all of that coming up next week. It's a busy week for the US and for the UK, obviously, two the biggest currencies on the planet. So you need to just be aware and have your wits about you. Let's just quickly go back to the indices. Hedged on the DAX, clean break on the FTSE. So DAX hedge, perfect upside target today. 5R is just shy of ADR and yesterday's high. Downside target, I'm going to move up to the 2-day low. Oops. So That's the low from Wednesday. So I'm just going to target that area because we're going to find there's going to be probably liquidity at that level. So obviously at the moment we're going absolutely nowhere today. So either we're going to come and test yesterday's high. Yesterday's low is basically that pre-market low candle there. So that is probably already held and we're going to rally. But if we don't and break that level, we're going to find support there. So I'll be getting out at those lows. Somebody asked me about this earlier in the week, and I kind of explained it with a little screenshot to them. But they were asking, actually, I think it was in one of the members, in the members group, if I could do a session on how I target with hedges, with the stock index hedge EA. So it's basically what I do every day in here. So whenever you see me get hedged in here, my analysis is always exactly the same. What is going to happen is price is going to move to test a level of support and resistance. So all it is looking for where is the closest achievable resistance and support. So for me, it's very obvious that the market pushed up into the highs yesterday and then pulled back. So we know there's sellers in that area. If the sellers want to remain short and we get back up here again, they will add to their positions. Yeah. And it's also at the average daily range, which is where we tend to find exhaustion creeping in. So that's an obvious upside target. So I'm going to leave that where it is. I'm not going to move it to there or just under there or anything because it's an area. Yeah, it's somewhere up there. There will be some pressure. Downside, that's too close. Yesterday's low. That's only going to be around about 2R. The danger is, obviously, if it gets to that, tests it and screams through it, I'm going to go massively into drawdown if I take off my shorts. So I'm always looking for something that's far enough away that we will have had to put in somewhere between three quarters of an ADR to an ADR of movement. Yeah, and it's usually going to be either yesterday's high or low or the previous day's high or low. If I see an area of confluence where you've got multiple orders triggering at the same level, that would be the best choice. However, if that's far too close, and if it does break that, it's probably going to pop through it, I'll be looking for the next area they bought from, which is the previous day's low. That's also a propulsion move off of a previous high. Yeah, so it's obvious that that is where they're going to buy from because they bought from there. They bought from there. When they broke through that level, they're probably going to add more sizing in there. And don't forget, with the SIH strategy, you're not looking for a massive bounce because I'm going to be taking off my shorts here, which means I'm going to be banking $1,000 or whatever. And I'm just going to target a small exit. So all I've got to do is wait for the distance of the hedge to pull back to exit the position. So yeah, so we're not looking for it to change direction. We're looking for it to bounce. And bounces happen at previous highs and lows because there's limit orders which make the market bounce. So that's the exit strategy. That's all I'm doing. It's either right or wrong. Yeah. So there's no rocket science involved in it. It's just a case of looking at levels. If we look at yesterday's trades, that was a clean break. Oh, they were both clean breaks yesterday, weren't they? So, and again, yesterday, I posted in the group, in the Discord channel, I got out here because the market wasn't going anywhere. Yeah. So if after, I don't know, 45 minutes to an hour, it is just doing that and I've got a profit, I'm taking it because it's not going anywhere, is it? Yeah, we did actually break after I took it off, but not before it went like that for another hour. Yeah, so just take it off. Same thing with the Dow yesterday. I got out here because we had a clean break south. It wicked back up. It came back down. It rebought. It wicked up. Came back down. It rebought. Wicked back up. Came down. I was like, I'm not having this. I just took it. Wicked up and then collapsed straight down to target. You can't see it's behind my head, but that's where my target is or was. Go away, pen. Yeah, so you probably can't see it, but that little blue dot there, that was my target, 5R. Yeah, so, but that was the call I made because of what I saw on the price action. Again, there's always going to be discretion involved in your trading. There is no such thing as a fully automated EA that's just going to make you money. You've got to be able to look at charts and understand where price is likely to go. And this is why we have all these on our chart, why we have previous days and yesterday's low. We have monthly, weekly levels, and we have propulsion gaps. Yeah, we did a whole session on it this week. We did 3 sessions on it this week, actually. Well, 1 on levels anyway. But there you go. Right. So, if anybody's got any pairs they want to look at, let me know. But I'm going to quickly whiz through all the pairs this morning and just have a look at what's gone on this week, really. Budget on the 30th of October, yeah. DAX, the DAX tried to break through yesterday's high 3 times yesterday. The DAX tried to break through yesterday's high 3 times yesterday. I don't understand the question. So yesterday, that would have been yesterday's high yesterday. It screamed straight through it at the open. I don't understand the question. Unless I'm misunderstanding, which I obviously am. Trump or Harris? Neither. I'm in the UK. Harris. For no other reason than the guy's an idiot. But anyway, I'm not American, right? But if I was American, you've got a choice. Do I want my country and my economy to flourish or not? Yeah, what's more important to me? That's it, isn't it? Really, that's your choice. Do I want the nice people or do I want the people that are going to generate a load of revenue? It's basically what it comes down to, isn't it? Korean troops are mercenaries and are considered Russian troops under international law. Are they? I did not know that. This means that Korea is not officially joining the conflict and they are also foreign legions in mercenary. Oh, well, there you go. From on the Ukrainian side. Well, if that's the Ukrainians' point of view, then that's, I don't know. What I know is war rallies the Swiss and the yen. That's all I'm interested in. So if it kicks off, I want to be buying the Swiss and the yen. But the Korean can send a lot of mercenaries, so it will be a problem. Yeah, I don't know. Who knows? International stuff. Morning, Evil. Not my style of trading, but I like what you do. Good morning from Chile. Cool. Then go and find someone that does your style of trading. You were talking about the US dollar positions and the election coming soon. Would hedging the open positions be a way to go flat? Yes. That's what I did in COVID. So if you've got a lot on of size on the US or the pound and you can't get out, what you can do, let me show you an example because I'm in the Euro US dollar and US dollar CAD. So let's say, for example, this is Friday next week. I'm long. My average is here. And I'm really hoping I'm going to be out of this afternoon. So come on, Euro, or let's have some negative news on the CAD because that will drag down the US dollar. But yeah, if it was the case of this is Friday next week, what I will be looking at is as an option, I've got buys on here. So I could place a sell order here for my entire lot size. So total up your lot size. Yeah, place a sell order short there. If this goes down and screams down for some reason, you're just going to lock in your current loss, basically. So you're just basically buying yourself time to analyze. This is exactly what we do with the stock index hedge strategy. Yeah, so we're hedged. So what I've done is I've locked in $360 or pounds in this case worth of loss, and I've now got the rest of the day to have a think. Nothing's going to go wrong from here. I am going to be somewhere between 360 odd in loss all day. So that's it. It's either going to sit there and do absolutely nothing all day, meaning I make no more than 360 or lose no more than 360. That's it. That's what it's going to do. Or it's going to do something. So I've just bought myself the time to watch this thing and let the market stop having donuts and coffee and go, right, let's press the button. Let's buy some stocks. Okay, brilliant. If you're going to buy some stocks, I'm going to analyze where I think you're going to go when you're going to finish buying your stocks. But I don't have to do anything. Worst case scenario, I can sit here all day, and this evening I can just shut out $360 worth of loss. It can't get any worse. Yeah? And that's basically what hedging is. You are basically saying, holy crap, I'm in 2.5% of drawdown on this. If this goes screaming down there, I'm going to go into 10% of drawdown. To stop that, I can place a stop loss, stop order there, and exactly the same lot sizes I've got on long. And all I will do is I will lock in exactly the loss I have on my account right now, and nothing worse can happen. And then I can wait and see what the hell's going on. What is the analyst saying is going to happen to the US dollar now? Are we going to rally? Is it going to pull back? We just basically are buying ourselves time, aren't we? That's what you're doing when you're hedging. You're locking in. So it's an option, and exactly what I did in COVID. When I saw the market collapsing for 2 days, on day 3 I hedged. I locked in a hell of a lot more loss than I would like, but I didn't lose my account. And as it happened, if I hadn't have locked in, I would have blown the account. I'd locked it in far too late. But you know, we've never had a pandemic. So it's your emergency brake. And it's only really in times like this. You can only really use hedging in that way in a predicted environment. So when you have something coming up that you know has a massive potential to move the market, you've got that opportunity. When something like a pandemic hits, or a nuclear bomb goes off, well, obviously that hasn't happened, but a nuclear bomb goes off somewhere, or there's an earthquake which destroys an entire area, and they're shut down, there's no power, the economy closes. Yeah, that's going to have a huge impact, but that happens so fast and the market reacts so quick, you don't get a chance to react to it. Yeah, when you've got something planned, so next Tuesday we've got the elections coming up, and next Wednesday we've got the budget coming up. I can look at any pound exposure I've got on Tuesday evening or even Wednesday morning and say, right, okay, I've got 3% drawdown on this in that direction, so I'm going to put a long on to cover that short lot size. And if this causes that to happen, that's my exposure. And I can sit here and wait for the market to go analyze this budget and then come back and say, right, okay, well, this looks like they're going to have to increase interest rates if this happens for the next year and a half, and we're probably looking at a 1.5% increase in interest rates. That's bullish. So I will then work the long side and start closing out the short to get out of the hedge. But hedging is incredibly complex. Once you're hedged, you have to get out of the hedge. And this is where everybody goes wrong with hedging. The exit of a hedge is very, very difficult, because if you are, let's say, for example, you're hedged with whatever, doesn't matter what the monetary amount of the hedge is. Your only way, if you are assuming the market is now going to go long, your only way to exit those shorts is to wait for a pullback. So you have to time the exit on those shorts perfectly, ideally, so that when it bounces, this movement outweighs the size of the hedge. And that's what you're doing when you're exiting hedges. This is your locked in loss, the size of that. When you've exited one side of it and the market moves the opposite direction by that a distance, you get break even. So you can close the whole thing out and go, phew. Yeah, that's the process. This is what we do with the stock index hedge strategy. Yeah, so we're going short. So I could now close my long positions, take a loss of whatever that is, and then when the market has moved that distance down from where I closed out my longs, I will be at break even. Or the other way to do the hedge is I wait for the market to get down there and I close my shorts, and I wait for the market to bounce back so that my long profit is, my long drawdown is reduced by the amount of money I made on my shorts, and I exit with a break even. Yeah, that's what hedging's about. It's about putting the emergency brake on. So just be aware you have that as a mechanism. We've covered this in the members streams. Hedging, not fun, not nice, and it's incredibly hard to make profit out of it. It looks really easy on paper, but go and do it. Do it with a demo account. I would always encourage you to go and try everything. Every strategy you see, every way of trading, every way of applying risk, go and try it on a demo account. See what the pitfalls are. Every single way of trading has a massive Achilles heel. If it didn't have an Achilles heel, everyone would do it and we'd all be millionaires. There's always a problem with every style of trading, whether it be stop loss, position trading, hedging, whatever you're doing. I mean, there's only really those three ways of trading, but whichever one of those risk methods you're applying to your trading, there's a problem with it. Yeah, position trading, the problem is drawdown. Stop loss trading, the problem is consistently losing money over and over again without you wanting to, because the market moves. Yeah, you can't avoid that. And with hedging, it's hedge size increase. So if you get the hedge locked in and you get the exit wrong, your hedge gets bigger. If you get the exit wrong again, your hedge gets bigger, and it just grows exponentially until you have a massive drawdown in your account that you can't get out of. And the only way then to exit it is to wait for the market to contract and work the inside of the hedge with a new hedge. So you hedge your hedge. It becomes, unless you've got a master's degree in mathematics, it becomes almost impossible to get out of the position. Yeah, that's the problem with it. But if you're incredibly intelligent and good at running spreadsheets and doing maths calculations, hedging's your thing. But you've got to try everything to find out what is your thing and what isn't. Yeah, like somebody just said, not my style of trading, but I like what you do. Brilliant. Go and do your style of trading. Yeah, there's no right or wrong way to do it. At the end of the day, when you press this button, there's a 50-50 chance of your trade working out. How you apply risk to that 50-50 probability is how you make money. There's 1,000 ways to do that, isn't there? But anyway, there you go. That was a waffle about hedging. Do you ever get the decision wrong regarding hedging? Yes. So with the stock index hedge, as I said, there's always an Achilles heel to a strategy. So the Achilles heel with the stock index hedge strategy is if I get out my longs here, let's zoom in so we can see. We're doing the session that somebody asked for. So whoever you are that asked for the session on detailed explanation of how to get out of hedges, this is it. So let's assume the market breaks long today. Yeah, it gets here and I exit the long positions. So my TP here is going to be $1,250. Yeah. So I'm going to make $1,250 on my longs. My shorts will be in drawdown by around, call it $1,600. Yeah, so my shorts are going to be $1,600 in drawdown. Yeah, leaving me a hedge of roughly what it is, $360. Yeah, so that you know, this is what I'm talking about with the hedge, $360, $350, something like that. Yeah, so that's my locked in hedge. So when we get here and I close out my trades, I am going to bank that, but I've got this drawdown. So what I need the market to do is pull back more than that to give me a break even. So it's not going to have to pull back far. So what I do with the SIH strategy is I use what's called an aggressive exit. So when we get here, we then place a pending sell order at the same size as our short. Yeah, so that when the market, if the market continues to go, that's fine. This drawdown just gets larger. But when the market does pull back, we trigger a short order, which doubles our lot size short, meaning that we only need a tiny little pullback of something like that, half of that movement, to get out of our trade with a break even. But what I do is I want the entire movement of the hedge down, which gives me a profit of roughly whatever the drawdown was. So I'd make something like 360. And you'll see when you get to target up here, the loss recovery target will trigger, and that will show you what your loss recovery target is. And my loss recovery target I have set is 20%, I think. Hedge recovery, half. So I'm looking to bank half of whatever's banked. So this move here is was 1,250. So I would be looking to bank 750 on my shorts. Yeah, you can change that to whatever you want. You can change it to 0.01, and it will just get you out of break even, for example. But the danger is I get out of my longs, I trigger a new short order. So I've now got a short here and I've got a short here. And then the market basically, as soon as it triggers, my order goes boing and it pings up and flies through that level. What you have to do then is you have to re-hedge at this point. So you enter the longs again. So whatever the lot size is, so in this case, it's 0.68. So let's call that 1.3. So I'm 1.3 short there. I'm going to be 1.3 short up here on this extra short that I've taken, which means I'm 2.6 lots short. So if it does that, I will then take a 2.6 hedge long here. What I'm now doing is I have a locked in hedge loss here of 360, and now I have a locked in hedge loss here of X. Don't know what it is. Depends on the size of the hedge. But let's say for ease of explanation, it's the same size hedge as that here. I'm going to lock in now $720 worth of loss as it screams off to the upside. So if it continues up to 150 ADR, I'm now making twice as much loss. That's it. But I can't make more than that, twice as much loss, because I'm hedged. I have the same lot size long as I have short. So if the market moves up and down for the next 10 years, I will be locked in at that, because it doesn't matter where it goes. The lot size long and short cancel each other out. Therefore, the loss is locked. So that's how you do it. And it does go wrong. Yeah. But it doesn't go wrong very often. And this is why I pick the targets at the levels that I pick the targets at. If this thing screams up here, first thing on my side is it's put in its average daily range. ADR gets exceeded 42% of the time. So 58% of the time when we get to ADR, the market is exhausted, which means it either stops or retraces. So I've got an edge of 58% probability that when we get to this line, the market's going to be like, I've had enough today. I've also got this on my side. The sellers are not letting the market go through that level. They are selling and adding to their positions there. So I know at yesterday's high, there are limit orders waiting because anybody short here is going to be defending that zone. So I've got the added probability of additional short orders at limits where they are going to trigger at least a bounce. If I get the bounce, I get out. That's all I need. So I've got ADR extension and exhaustion with limit order triggers at an area of propulsion where we had a large order entered into the market. Yeah, confluence. So if it does that and then does that and that, these guys are going to get run over. Fair enough. There's way more volume of buys today and that's it. So I will re-hedge and make a double loss. But the number of times this happens, this scenario, compared to the number of times we just get the bounce and get out, is tiny. Because, you know, of probabilities. This is what the whole, I've got a session planned on this for the members streams, is probabilities of trading. Your whole system and strategy has to work around probabilities, and probabilities are based on previous history. Yeah. So I can tell you for a fact, over the last 25 years, the chances of moving beyond the average daily range on average are 58%. It's not me making figures up. It's fact. It's written in stone. Average daily range gets exceeded 58% of the time. Do the research yourself. You'll come back with the same numbers I did, because you can't come back with anything different, because facts are facts. Probabilities. Yeah. When we get to 125 ADR, there's a 23% chance of price going through that level, which means there's a 77% chance it's not going to go through that level. That's a big edge. Yeah. If this hedge here fails and it breaks and I re-hedge, I'll be trying to get out at the next level of sell orders, which we know is here, which is also got a much higher probability of a bounce, because the market's going to be not just exhausted, really exhausted. Think about running a marathon. Yeah. Some people will get to there and then they'll have to take a rest before they continue. Some people will get to there before they have to take a rest. But the number of people that get to there before they have to take a rest is tiny. Yeah, these are the superhumans. Yeah, the 10%. You get to here, there's only a 12% chance it'll actually exceed that level, historically. So all you're doing with all trading is putting the probabilities in your favor. You have no idea what's going to happen at that level. Yeah, when you get to this level, and we've covered all this in the member streams, What happens at that price point there is dependent on one thing and one thing only: the volume of buy orders versus sell orders in the institutions today. If we get to this level and there's 100 million going long, and we get to this level and there's only 50 million going short, we are breaking that level, because these guys have got 100 million orders to execute and these guys have only got 50 million. So when these guys have eaten those 50 million, they need more 50 million more orders executed. So they'll go and find them. They'll be up here somewhere. We don't know where, probably there. That's how trading works. There we go. That's how it works. And you are going to have hedges which don't work. But you could use a stop loss, but you're better off just locking it in and then going, your stop loss is basically end of day. So end of day, every day, regardless, it's closed. The orders are all closed at the end of the day. Whatever that number is here is what it is at the end of the day. Do you take the pre-market or post-market? Pre-market. Thanks, Lee. Takes balls to double size your position of a hedge. It doesn't take balls. It just takes. It's just what you have to do. If you want to get out, you have to get. But that's what I'm saying. It's all about probabilities. At the end of the day, isn't it? Trading is probabilities. You have no idea, and I have no idea where this is going today. You couldn't phone a central bank now, a bank now, and go, which way's the DAX going today? They can tell you what orders they've got on their books, but they can't tell you if the orders on their books are bigger than the orders on everybody else's books. So they might say, well, we're executing tons of Mercedes stock long today. We've got 200 million of Mercedes to buy today. Yeah. But they don't know in HSBC whether Barclays have got 500 million of Mercedes to sell today. If they have, it's going down. Yeah. Nobody knows where this is going. It's all weight of order and probability. But we do know historically that the market has an infinite amount of executable capital per day. And on average, it will move there. That's it. It's a probability, but it's a mathematical, statistical probability, which is why it works. Because it's an edge. All an edge is, yeah, every time you press the buy and sell button. I'm going through the entire members stream that I've got planned. Anyway, I won't do that one. All trading is a mathematical probability. Yeah. So when you press the buy or the sell button, those are your odds. If you want to win, you have to put the odds in your favor. We call it an edge. Yeah. So if 58% of the time price doesn't go beyond that level, there's a short edge when we get somewhere up here, isn't there? So the odds are not 50-50 anymore. They are now 58-42. It's a mathematical probability. Yeah. If you have an area that has consistently proven to be a sell area at that level, I would say that 58% edge we have is probably now something like maybe 62, 65%. I don't know. There's no way you can put a mathematical calculation onto a triple top high at an ADR. However, it's probably more than that because we know limit orders are there because we can see them on the chart. So I would say the odds are higher. So that's how I work out trading. It's a mathematical probability. When you get to a level that has consistently not broken, the mathematical probability of it not breaking is higher. Simple as that. You can look for every system and strategy under the sun, and they will give you a strike rate. But the strike rate of the system and the strategy is not based on the entry. It's based on the exit. It's based on the exit long and the exit short, your stop loss and your take profit. You know, I get asked all the time about the market reversal alerts indicator. What's the strike rate of this indicator? 50-50. Sometimes it works, sometimes it doesn't. Well, how can you have something that's got a strike rate of 50-50? 50-50 strike rate is dependent on where your TP and the stop loss is. If you put a stop there and a TP there, the strike rate of this indicator is probably 99%. If you put a stop loss there and a TP there, the strike rate of the indicator is probably 30%. The indicator has nothing to do with the strike rate. Whether or not the trade is successful or not is the strike rate. Whether or not a trade is successful or not is dependent on the placement of the stop loss and the placement of the take profit, not the indicator. This is where everybody gets confused. What's the strike rate of bouncing out of propulsion gaps? I don't know. Where's your stop loss and your TP? If your stop loss was there and your TP was there on that one, 100%. If your stop loss was up here and your TP was at 50R, we'll wait and see. But I would imagine it's probably not going to work out for you. It's nothing to do with this. It's to do with where you place those things, isn't it? This is what hedging is so good, because it basically locks in the probability. You've definitely got that loss. So now let's look for a way to not have that loss with a 50-50 probability. We also will then get a break even. So it just buys you the time, doesn't it? Anyway, we're talking about other stuff. I haven't even done any analysis, and we've got the member stream in 10 minutes, so I'm not going to get through it today. There's a guy called Mark Sean. He was always using hedging but stopped. Nick Sean, you mean, not Mark Sean. He now position trades. Yeah, yes. We had a conversation about him in the members stream on Wednesday. I'm not going to go into it. Yes, but all I will say is run a mile. Yeah, the guy's a con artist. Do not get involved. Basically, all I will say is, if you do a stream on trading, and you're getting me into it now, Wayne, but if you do a stream on trading and you open the stream by shooting a gun at people or pointing a rifle or a pistol at someone, you should be not only kicked off of YouTube, you should be locked up in a bloody prison cell. It's got fuck all to do with trading, having a rifle on the stream, right? Yeah, so there you go. Anyway, so he's blown all of his accounts, and now he's copying me because this works and what he did didn't. So now you're going to buy a course on position trading from him, although you can get it from me for free. And then when he blows his account because he's doing it all wrong, he will then go back to another strategy and rinse, repeat, and keep taking your money until everybody stops. Never ending cycle. I call him the blue Porsche guy. He bought a blue Porsche by selling courses, not by trading. Morning, Evil. Oh, thanks, Evil. Is your TP for the clean break 1 to 1 or 1 to 2? 1 to 3. So 3 are on the FTSE. So you've got 2 targets. You've got 1 target, which is your clean break, scalp, and then your runner. So I have 3R and 5R. You could use 1R and 3R, or 1R and 2R. You can use whatever you want. It doesn't matter. Again, strike rate. Yeah, your strike rate will be determined by, if you had a 1R today as a target, you're out. Nothing wrong with that. So if you've got a strike rate of more than 50% clean breaks, that will generate alpha. If you haven't got a strike rate of more than 50% on clean breaks to 1R, and you're targeting 2R, your strike rate will be lower, but your reward will be double. This is how it works. It's all maths. All trading is maths. Literally, it is maths. It is applying risk to a random movement of price action based on banking institutional order flow. That's it. That's what trading is. You have a probability of 50-50. Yeah, and all you do is you apply a ratio to the probability to try and create an edge, which creates capital growth. That's it. That's trading. It's so simple. Everybody spends their entire life hunting, like Nick Sean, for a strategy that works, but they can't execute the strategy because they don't understand what trading is. Anyone can trade a strategy. I can teach a monkey to trade a strategy. He won't make money because he doesn't understand risk, market movement, and the stuff that makes the thing work. Yeah, the mathematics behind it. It's all maths. Simple as that. But that's, we've all spent our time doing it. I did it. I spent a long time trying to find the Holy Grail. It doesn't exist. There's no such thing. It's just applying a mathematical equation to a random price action. That is how you make money. It's very simple. Go and toss a coin 100 times. Yeah. And every time you get a heads, give yourself £1.10. And every time you get a tails, give yourself £1. If there's more heads than tails, you'll come out up. If there isn't, you'll come out break even. That's it. Because you will get a 50-50 ratio on heads and tails at some point. If you toss it 100 times, you might get 80 heads and 20 tails, which means you make a load of money. But now toss it another 100 times, you might get 80 tails and 20 heads, which gives you back a break even. But if you've got a 1.1 risk reward ratio, you will always come out on top. It's just maths. Simple. You just need to understand that you cannot apply anything to this market that will repeat itself with any degree of probability, because it's random. Every day is different. Anyway, I've waffled on today, so analysis is going out the window. I haven't got time to do it. If you're coming into the members streams, we're looking at Phil's strategy in more detail today, which is this one, which is nice. So I've applied the Swiss Army Knife EA to Phil's strategy, and I had it working yesterday. I've made some tweaks this morning, so I'm hoping it's still going to work. But yeah, it's working. So we'll be able to test some different exit criteria on this morning. The Swiss Army Knife EA is not really designed for hedging, for position trading, which is kind of the approach to this. So I've got other exit criteria that we can apply, including exiting based on number of entries. Yeah, and I think that's probably the best way to control drawdown on it, is by using a number-based exit mechanism rather than a time-based exit mechanism. So yeah, but it's working well. I've now got spacing working correctly, so it's all working as expected. But again, like everything, there's going to be manual intervention needed on this, because it needs to be taken as a portfolio approach. But we'll do some more testing on it this morning. But I spent all afternoon basically coding it into the Swiss Army Knife EA. So we'll see what happens. But yeah, it's looking good. Looking good. So we're doing that today. So nobody's said they got any pairs they want to look at. So I'll probably call it a day there. Just watch these yens. We had a lovely pullback yesterday on the yens. I took a Swiss yen short this week. I had a break-even exit on it this morning and last night. I'm waiting to see what happens today. We've got no news today. We have got news today, but no real news today. So down to here is basically my target. So I'm looking for a retest of propulsion, which is a 50% pullback. Again, with this one, it's a short, so the carry is going to be expensive on it. I'm already $220, $230 in swap fees. So this move down to here was actually only worth about $100, even though I'm that far beyond my break-even price. The swaps are costing. So I don't want to hold this too long. I'm going to monitor it today. If we get another, actually, I'm just going to put an alert here. If we get another attempt at the lows of yesterday today, I'm going to be watching this like a hawk, because that is an exit. The trade hasn't played out. It's gone parabolic 2 ADR, 2.5 ADR up. So it's either going to do an A-shaped recovery with yen strength, or it's not. And if it doesn't, I've got a feeling the carry trade is going to continue against the yen. So if we do get down here today and it looks like it's starting to bounce, I'm just going to close it and just take it to take a break even, basically. Obviously, if it rallies, I'll make another judgment call on it. But I'm only 0.5% in drawdown on it, so it's not the end of the world. The other positions I've got on, US dollar CAD, added another yesterday up here. As you can see, I'm starting to get aggressive on this now. Waiting to see today if this is holding. So we know that this was the peak formation high. The news for the Canadian failed. Yesterday they sold the CAD off. That was due to the oil drop yesterday. So we had oil yesterday dropped dramatically. However, as you can see, we're playing a gap down scenario here at the moment, and we haven't done the gap fill. So I think there's a good chance that oil will rally back up short term over the next week, which will obviously give the CAD another boost. So Canadian, obviously big oil net exporter, so oil price affects the CAD a lot. It's a commodity pair. So we'll see what happens. But I'm looking basically for any weakness in the US and the or strength in the CAD today to come and retest these lows. yeah, I mean, my average is very close. I only need 1.25 ADR on this. So looking for a news event, really, just a news event or some kind of rally for an exit, but just stuck for the whole week. We've just been grinding after the 9-day propulsion move. So stuck in that one at the moment. Same with the Euro US. Beautiful moves on this yesterday. We had some decent news out of the Euro yesterday. So we had Lagarde sort of saying things are going pretty well. Everything's going well with the economy. We're on top of inflation. Interest rates are where they need to be. We're going to drop by another 0.5%, which the market already knew. So there's a good chance of a bull move on the euro, but we're going to need that US either to stay neutral or to weaken for the euro to be able to take it. So again, as you can see, break even on that is an hour away after this long hold on this one. So yeah, very easy exits on everything. I just need one news event on the US to get out, really. So I'd love to be flat. So I've basically turned off the EAs on all pound pairs for the moment. They are on the pairs that I'm running, but I'm not trading anything else with the EA automated at the moment. So I've turned them off this morning, so I won't be taking any new positions. My aim is basically to try and get flat next week, and then just wait and see what happens with the US elections. And as soon as US elections are over, obviously the market will either recoil or whatever it needs to do. But yeah, Wayne, thanks. The most useful hour regarding training on YouTube today probably is, because most of the other people out there are trying to sell you some crap. Anyway, today, member stream about to start in 5 minutes time. I'm late again. So we're going to cover more details on that new strategy that Phil's come up with and try some different exit criteria on it. At the moment, the strategy works pretty well on its own. It's got an Achilles heel of large drawdown. So I'm trying to find ways to reduce that drawdown today. So we'll be delving into that in more detail. And it's to general, I think today I've put down as a general sort of Q&A type session. Oh, it doesn't show the upcoming for some reason. Yeah, more daily. Yeah, I'll change that to Q&A as well. So today's basically going to be a Q&A session in the members stream. And also, well, obviously we do that strategy testing, right? So good luck with whatever you're in. Anything you need, let me know. I'll be in Discord. And I'll be back on Monday. And we'll get more prepped for the busy week that we've got coming next week. Obviously, just be aware today we've got that CAD retail sales. So potential big move on the CAD this afternoon off the back of that retail. We have also got Michigan. If Michigan comes out negative and the CAD retail numbers are positive, that US dollar CAD, I'm out today. So it's good opportunity to get out today, but obviously there is an opportunity to go the other way as well, as always. All right. Have a good day. Anything you need, let me know. Otherwise, I will see you next time. If not, I will see you in the members stream in about 5 minutes. Have a good day.